What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about one brand new stock. I can't remember if I actually talked about this company before, but this is a phenomenal business, very, very high quality company. And we're going to take a look at the intrinsic value for this company as well, because you'd be surprised where it's trading at the moment, right? And we'll be taking a look at we'll be taking a look at the fundamentals as well. Can't get my words out. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. And again, you get access to all the members only private videos and of course individual stock reports and buy and sell alerts, options alerts, trade ideas, trading view charts. Everything is going to be included with the link down below. And I've opened up a few more spots, and until the end of October, there's also the 16% annual discount that's back once again available for you to take advantage of it. So links are going to be down below. And the company we are talking about today is going to be Endava, ticker symbol DAVA. My team and I did a research on this company more recently in the last couple of days, and I will be publishing the report, the stock report, for everyone to analyze and view. And this right here is straight from our research report. So what Endava does is basically a software development and cloud and IT consulting company. Majority of the services that they offer are such as business analytics. We got data and analytics, digital product strategy, private equity value enhancement. There's a lot of cloud and technology related services that Endava offers. They're actually based out of London, UK, and they're present in over 28 countries and across 67 cities, and established in 2000. So it's been over 23 years that they've been in business. And again, they got business intelligence, data warehousing, big data analytics, visualization, a lot of those types of services that this company offers. So we have very, very good margins for the company. Not as much, but they can get better, right? And there's a lot of products and services that this company offers. I think this our research report basically had over 20 products and services that this company offers in their business strategy. So very, very vast business model with a lot of potential for growth and a very big TAM as well. If you take a look at the revenue, so in 2023 the revenue came in at just under $1 billion. So we're not talking about a super large company. This company is only valued at $3.3 billion, and majority of the revenue came from payments and financial services, which is approximately 52% of the company's business, and technology, media, and telecommunications contributes to 22%, and others contributing 26%. And the geographic breakdown, of course, majority of the revenue coming in from the UK, which is approximately 39%, and the remaining contribution came from North America at 32% and Europe at 23%. The rest of the world coming in at 6% as well. So two major revenue streams: payments and financial services, and technology, media, and telecommunications. Those are the two umbrellas, and everything kind of falls under those two sections. And this right here is the SWOT analysis. So weaknesses, opportunities, and threats. I wanted to go over that more specifically. Strengths you guys can read in the report at your free time. But there is revenue dependency on a limited industry verticals. What that means is the company's revenue relies heavily on a select few industry sectors. Any decline in demand for technology services within these sectors or difficulties in entering new ones could have adverse impact on financial performance. So they are kind of reliant on a few different sectors that they belong to, but that's also where the opportunity comes in, right? Sometimes it's kind of like, yes, that's a weakness, but that's also an opportunity. Because why? Because they're able to do almost $1 billion in revenue with just 2 sector penetration. So that means there's a lot of opportunity in other parts of the market that they haven't really addressed yet. So large addressable market, right? So it is anticipated to reach $3.4 trillion by 2026. The IT consulting, the software development market is expected to reach trillions of dollars by 2026, and they're a very, very small player in this market. North American market expansion as well. So Endava currently has minimal exposure as the world's largest market. So North America only makes up less than 1/3 of the overall revenue. So there's a lot of potential opportunity there as well. Now, competition-wise and threats-wise, there's going to be competition, dependence on third-party software, inflation risks, and they are listed as an ADS, so American Depository Shares, on the New York Stock Exchange. So that's, again, some geopolitical tension and some trade tensions between Endava and, of course, the US as well. So those are some threats that we do point out because we want to be as exhaustive as possible. But a lot of them obviously don't fully apply to these companies, but most of them do. So if you go over to the fundamentals here for the company, so revenues, very, very significant growth, and we're going to run through this together. I wanted to do this exercise with you guys to kind of help you understand, all the metrics that we like to track, and I've actually included more. So our MoneyVest metrics total are going to be over 70. Those are the ones that we are going to analyze for every stock that we are looking into. So moving forward, that list is actually going to be much bigger, but I can bet once you have the numbers in, you can analyze any stock in and out in under 10 minutes, right? It doesn't take me that long. Even right now, when we're going through these numbers, it's not going to take us that long. So revenue here, look at that. From 100 million to over a billion in 2023, almost a billion. We're looking at a 28% growth CAGR here. Gross profit, 37 million to over $342 million. That's up 28%. We got operating income going from 17 to 154 million. That's 27.7%. So very, very nice growth here. And of course, we got EBITDA going from 19 to 180 million. That's up over 28%. And net income's gone from just under 14 million to over 119, almost 120 million dollars. It's up 27%. And operating cash flow, again, 25% growth year over year. So these are big check marks here, right? Because numbers are in the double digits, 27, 28% growth, 25% growth. CapEx has also grown 23%, but it's a very, very small percentage of the overall revenue. So it's under 2%. We're going to give that as a check mark. Free cash flow up 27%, check mark. Free cash flow margins are slightly down from 9 years ago, but that is again very comparable, right? It hasn't grown, but it is somewhat flat. So we're gonna give this as a check mark. Operating cash flow margins are slightly down 3%. So again, it's not a huge decline in those margins, but it is more or less flat here. So I'm going to keep that unchecked. And net margins are slightly down 87 basis points. So that's going to be a check mark. We've got expanding EBITDA margins, 44 basis points, and gross margins are basically flat, right? So we're going to keep that as a check mark as well. And finally, earnings per share is up 24.5%. That's a check mark. And shares outstanding have also gone up by just under 2%. So they're not diluting a lot when it comes to shareholders here. So that's also really good. Now, when it comes to the balance sheet, we have current assets growing at 25.7%. That's a huge check mark. Current liabilities are only up 18%. So they're growing their liabilities at a slower rate compared to their assets. So that's good. Inventory is nothing. There's no inventory. Cash and investments are sitting at over $209 million. And I looked at their balance sheet. They didn't seem to have any debt on the balance sheet either. And even Seeking Alpha right now on the financial tab doesn't show any long-term liabilities. So current portion of long-term debt is zero, and long-term debt itself is also zero. So that's also going to be a huge check mark, because not only do they have zero debt, they've also got a very, very good net debt. So they've got more cash than debt on the balance sheet. So negative net debt, that's exactly what we want. And total assets are also 35% growing every single year. Total liabilities are growing at a slower rate compared to assets. Depreciation expense is up close to 40%. It's sitting at over 41.7 million, but it's also a non-cash expense. So that's pretty good. Interest expense is again low. Negative 4.7 million. That means the company's actually making interest income. Let me just quickly double check here. So financials, we got income statement. If you come down, so interest expense, that is going to be negative 4.7 $1 million. So in interest and investment income, that's going to be 4.9, and they're spending net interest expense at 0.3 million. So their net interest expense is actually a positive number because they are actually generating more money from the income that they're generating, right? Because of the cash they have on the balance sheet, right? So that makes sense because they've got all the cash, $209 million that they've invested. So the income that they're generating from interest is more than the interest they're paying on their debt, which is pretty much zero. So they have a negative number because they are actually making more money. So that's good. Goodwill intangibles are only, well, actually this is somewhat of a big deal because 39-40% is a pretty substantial number as part of their total assets. So I'm going to keep that unchecked. And this right here, current ratio 2.8, quick ratio 2.8. So those are very good. And we've got, again, debt to free cash flow under 3. Total assets, total over total long-term debt here. Long-term debt is 0, so that doesn't matter either. We got net debt to EBITDA is also under 3, so we're going to check that off. Cash to debt, again, no debt, so there's literally going to be checkbox here. Total assets over total liabilities, 3.87, so that's fantastic. Interest coverage ratio, again, doesn't matter because there's no interest expense. Solvency ratio is also really high. Shareholder equity has grown by 43%. So just take a look at the sheer amount of good checks this company is getting. And then finally, if you come over to the return on capital, assets, and equity, now this would be unchecked because they have not really become more efficient. And that's one of the things that I wanted to touch on is that you'll notice that the revenue, earnings, profitability, everything has grown, but margins have stayed flat or are slightly down. And that's being represented over here that their return on assets, equity, and invested capital has gone down, right? So it's gone from 21-40% down to 12 to 16%. So that's a little bit of a issue considering telling us that, they've hired a lot of employees, they've increased their revenues and earnings and whatnot, but they haven't really become more efficient, right? You want companies to become more efficient as time goes on, and revenue per employee, net income per employee is more or less the same as 10 years ago. Now, valuation's also quite reasonable. We're working with 17, 18, 25, 28 times earnings multiple. So if you come over to valuations here, you'll notice that we're looking at 27, 29 times earnings multiple. Price to sales a little bit over 3. Price to cash flow a little bit over 20. And enterprise value to EBITDA, we're looking at just about 19, 17 times. So when we do our analysis on this company, this right here is the expected earnings from 2024 to 2026. That's a 37% growth. I'm going to go with a little bit more modest 24%, 24 times PE multiple, 20% cash flow growth, because in the last 9 years, they've grown cash flow by over 27%. I'm going to go with free cash flow multiple of 20, which is exactly where the price is trading right now. 12% discount rate. We've got 10% margin of safety. We got 2% share dilution, which is very comparable to what we have seen before. 50% weighted average here between earnings and free cash flow. And we get down to a fair value of $52 per share, and right now Endava is trading at 57. So we're actually not that far off, only 8% far off, and guess what? It actually was trading as low as 45 before rallying quite a bit. So this right here was the entire move higher for Endava, pushing up over 34 to 35%. And it is down. It is down quite a bit from its all-time highs. From its highs of 173, the stock is still down 67%. So in my opinion, there's a very, very nice support sitting right over here, $44. At 44, based on the analysis that we have done today, in my opinion, I think Endava could be considered as undervalued. And there's also a resistance that it's coming up to right now, in line with this previous support, now acting as a resistance at $61 per share. So this is a stock that you'd most certainly, in my opinion, want to add to your watch list and keep track of this company. And this right here has been the overall downtrend for this. So it's been trading into this, lower highs and lower low pattern, getting rejected inside this downtrend. And right now we're coming up to that resistance of very, very cleanly getting rejected at around $61. So 44, very, very strong undervalued level based on this analysis, and just a lot of check marks here for Endava. And again, fundamentally, and you can take a look at the graphs here, very, very nice consistent growth in revenues and profitability and earnings, very stable numbers. And a lot of the analysis that we just did can be seen over here. So return on assets, equity, invested capital, once again, 13, 18, 16%. Good current ratio. Come over to statements, balance sheet, negative net debt. And if you come over to cash flows here, this right here is going to be the cash flows growing, more stable in the last year. And then, of course, shares outstanding have not really gone up all that much, although 1.7% is still a reasonable number. So $44, very strong support, $61 resistance. If you do end up breaking out above this level, there is possibility that we do see some more technical upside and potentially seeing the stock back up to over $84, $85. That's going to be a 41% potential upside for Endava moving forward. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, if you enjoyed it, found it helpful, make sure that you drop a like. If you want to get access to all these stock reports that are going to be available for you to view, analyze, and evaluate companies on your own and add these stocks to your watch list, link is going to be down below. And we'd love to have you on board. As always, happy investing. I'll see you all in the next video.